So when does a revolving credit loan actually cost you more than a standard fixed loan? Well, revolving credit loans are on the floating interest rate, which are generally higher than the fixed rates. Now, if you use a revolving credit really well, if you're super organized, you can have money sitting inside that revolving credit, and therefore you're paying less interest, and therefore your effective interest rate is lower. And that is a way that you can save money on your revolving credit. You could even, fill up that revolving credit with cash, and you'd be paying a 0% interest, no repayments at all. Okay, so you can certainly get it to be down there, but where it ends up costing more is because you might have a $30,000 revolving credit, but you've got no money in it. All right, so that's one example, and therefore you're paying that floating rate because you've got no money in it, offsetting that high interest rate. Or maybe you've just made your revolving credit too big. So if you've got a $300,000 mortgage and you were to have a $300,000 revolving credit, then you've got to be paying that high interest rate on that whole $300,000 less whatever funds you've got in that account, right? So that would be pretty inefficient and pretty ineffective. You don't have to have your revolving credit being as big as your whole mortgage, but you might choose to have a portion of your mortgage as a revolving credit. Maybe you have 30,000 and then you've got 270,000, which is fixed. And you can do stuff like that, which would allow it to be more efficient, provided you've got some funds to put in that revolving credit. Because if you don't have funds to put in there, then there's kind of no point.